Giving to others through our shared time, talents, knowledge, and financial resources can be a fulfilling practice, supporting the causes we believe can impact lives beyond our own. Showing generosity through charitable giving acknowledges the belief that we have defined enough for ourselves and are fortunate to give to others without expecting something in return. This lesson focuses on tax optimized methods for donating to charitable organizations with financial resources, reiterating the intentional direction of your wealth in alignment with your unique values. Let's start with the idea of making tax deductible contributions. As we'll cover during the tax return lesson, the most common way households benefit financially from charitable giving is by itemizing their deductions, by paying for qualified medical expenses above the income floor, state and local taxes, and home mortgage interest, and giving qualified charitable contributions that all combined exceed the standard deduction based on their filing status. Over the past decade, three major variables have dramatically reduced the direct federal tax benefit of charitable giving. Two of them relate to the Tax Cuts and Jobs Act of 2017, also called TCJA, in which the standard deduction amounts were nearly doubled and the state and local taxes deduction was capped at $10,000. And the third was the reduction of mortgage interest rates, with the 30-year fixed mortgage rate moving down from 5% in 2010 to 2.75% in 2020. So, on a $500,000 mortgage, that changed the first year of deductible interest payments from $24,800 down to $13,600 for families who financed or refinanced. Interestingly, when I'm recording this, the 30-year fixed rates are now back over 7%. Although the likelihood of itemized deductions has been dramatically reduced, thankfully there are other tax-optimized charitable giving opportunities still available. One giving strategy, even if you can't itemize your deductions, is the donation of long-term appreciated securities from taxable brokerage accounts. Since the future realization of long-term capital gains during life may be subject to the 15% or 20% capital gains tax rates, plus any state income tax, it's generally better to give appreciated securities directly to charity rather than giving cash from a bank account. Of course, assuming you are planning to give to charity anyway. Giving investments doesn't necessarily have to be viewed as an investment strategy or a way to time the market. When you give securities instead, other cash you would have given to charity can purchase additional shares of those same investments. One important note here, it is unwise to donate securities at a loss. It would be better to realize that capital loss for tax purposes and then donate that settled cash if it's the only available source of funds. As we saw during our previous lesson, the tax impact percentage column on the spreadsheet divides the unrealized capital gain into the balance. The higher this percentage, the greater the tax consequence per dollar amount sold. This family owns the YOLO Large Cap Fund within their joint taxable brokerage account. This could be a great candidate for charitable giving since it has the highest tax impact score of 30.5%. Assuming this family had an adjusted gross income of $300,000 in retirement, their donation of this fund could avoid the future 15% long-term capital gains tax, 3.8% net investment income tax, and based on where they live, 6.85% New York State income tax, combining to save about 10 cents per each dollar given. I've also seen examples with the tax impact percentage over 95%, and that's without itemizing their deductions. For additional clarification, this calculator example assumes they would have otherwise realized those long-term capital gains to support their lifestyle expenses, not that the mutual fund would have been inherited with a stepped-up cost basis upon death. The next tax-optimized giving strategy is the use of a donor-advised fund, DAF, which allows irrevocable charitable gifts of cash, securities, or other assets to a centralized charitable account. The donor can then grant the funds to any IRS-qualified public charity. Using a donor-advised fund can help households increase the tax benefit of their gifts by allowing them to stack multiple years of charitable donations into 1 year, including that given value in their itemized deductions, and finally, granting those funds from the account to their desired charitable organizations in future years when they might claim the standard deduction. Combining the strategies of giving appreciated securities to a donor-advised fund, I've seen families save over 50 cents per dollar given. If you're interested in implementing these strategies, just be sure to keep an eye on the AGI limits for charitable giving, based on which types of property are donated, which I've linked below. The final tax-optimized giving strategy that I'll share is reserved for IRA owners over age 70 and a half, called Qualified Charitable Distributions, QCDs. By donating traditional IRA funds directly to qualified charitable organizations, The distribution is not taxable, nor included when calculating future Medicare surcharges, IRMA. This QCD strategy can also apply to those annual required minimum distributions. So, whether you're over age 70 and a half or know someone who is, spread the word. It's the best way to give to charity from a tax perspective. Charitable giving is one of the most rewarding financial planning areas, and you may be able to calculate the tangible value of your strategy as a dollar amount moving forward.